Good morning. We will be starting the webinar in 2 minutes. A special welcome to people on social media who have clicked on to explore how you might be able to maximize your business valuation, or you might be an accountant or a bookkeeper looking for more information about the services that ESS BIZTOOLS provide so that you can contribute outstanding services to SMEs to help them achieve their goals in running a small business. If those of you who are watching on social media, and welcome, have any questions during the webinar, unfortunately you're not able to communicate directly to me whilst we're presenting the webinar, but you could send me an email, peter@essbiztools.com.au, and I will get back to you. Good morning if you're watching in Queensland. If you're watching in New South Wales, Victoria and Tasmania, obviously it's now afternoon. Welcome to this presentation on maximising business sales value for SMEs. I'm Peter Towers, the founder and managing director of ESS BIZTOOLS. I hope that you're having a wonderful day. Is this myth correct? It's a buyer's market. The vendor cannot improve the price offered. I suspect a lot of people agree with that comment, but in fact, I believe it's not correct. As a professional advisor, you are in a perfect position to disprove this myth. And I think as a profession, we should be trying to disprove the myth. Some people argue that it's always a buyer's market, and it well might be, because in Australia at present, there is high levels of business failure, some of the highest on record. But let's go through a process whereby you can be involved with your client right from the very beginning in encouraging them to think like a public company if they are going to ultimately maximise the financial return that they can obtain from exiting their business. Not rushing round at the very last minute trying to work out what the value might be, what they can ask, what training needs to be done, what manuals need to be updated, by implementing a plan from day one for the exit, which might be many years away, of course. Why? Because the price multiplier used to determine the value of a public company at the initial entry onto the stock exchange is substantially higher than what is normally attributed to a private company. And you might say, well, that's not fair. Well, it is, because a company getting ready for the initial public offer has undertaken business improvement processes. If they needed to undertake them, they may have already implemented. They may have been the type of client that I'm referring to today. And I'm going to give you an example of one that I actually worked with later on in this presentation today. So the public company, or the private company, trying to change its status to a public company via an initial public offer has systems in process that will enhance the valuation of the business. Now, if you're not familiar with this process, you might be saying, well, such as what? They've developed systems for every aspect of the business operation, every aspect, from buying raw materials to the stock control system to the manufacturing process, if that's what the company is involved in, to the storage of the completed stock, to the selling of the stock, the debtors control, the financial controls. All of these systems are incorporated within a comprehensive systems manual. And the company's intellectual property is also documented. How much is being carried around in the head of the CEO? To list on the stock exchange, that's not thought to be very smart. It needs to be documented so that if something happens to that CEO, that all that information just doesn't disappear with him or her. Does some of this already sound familiar to some of your clients? Potentially, intellectual property could be protected by patents or confidentiality agreements that are being used with clients, and some businesses never worry about patents. They use secret documentation. Every business needs a business plan, but I'm continually amazed at the number of small businesses that haven't got a business plan, or if they had no input into its preparation. Someone just went off into their office and prepared a business plan and gave to them. And unfortunately, it was only being prepared to satisfy the bank manager. I think that's a complete waste of time and effort. Because to prepare a business plan, you need to work with the client and their leadership team to get their input on every aspect of the business plan. Why? Because they're the people who have got the prime responsibility to implement the business plan. And I found over the years that when I've been called in to try and help someone to get their business back on track, and I talked to the leadership about the business plan, they just throw their arms in the air and said, well, so what? We had nothing to do with it. It's completely unrealistic. The goals, I've now read it, but they don't mean anything to me. You need to make sure your client's got the leadership team firmly behind. In fact, I think at the end of the business plan being prepared, you should ask each member of the leadership team to pick up a pen and to sign the document. This is our commitment that we are going to help implement this plan. Now, this is all part of what does a company have to do to improve its price multiplier. A business plan is vital. And then the next step is the financial interpretation of the business plan. And that's what budgets, cash flow forecasts, and projected balance sheets are. They're what we now call the predictive accounting process. But you can't have someone go off and prepare the budgets and the cash flows and the projected balance sheets unless they've got a very firm eye on what the business plan says. And some years ago, when I was consulting to a major Australian government program, I come across situations where, because the client had a couple of mates, one was good at business plans, I was told the other one was good at budgets and cash flows, they'd gone off and prepared them quite independently of one another. Now, I had a meeting with them prior to them starting the work, both of them, and I said, now, this is a joint process. The business plan needs to be completed first, and then the budgets and cash flows and projected balance sheets can be prepared. But no, they went off and did their own. And when I read the document, I said, this is no good. We've got a business plan that's saying certain goals, and then we got budgets and cash flows saying others. And what we were using those documents for was to assist those companies to then go to the market under the Section 708 of the Corporations Act, because that's all we had at that time, to raise capital. Investors would not be interested. We had to restart the whole process. And then I insisted there was only one preparer, the business plan and the budgets and cash flows, but the preparation was to be done in conjunction with the leadership team. So that is very important. The business has implemented a rhythm of meetings, daily, weekly, monthly. It is very important. I produce 2 or 3 podcasts and webinars a year with Andrew Geddes, who I believe is the outstanding trainer of accountants in public practices in Australia. Andrew was one of the joint founders of the Financial Management Research Centre, which was originally at the University of New England 44 years ago. And he then had a brilliant career as a key advisor to accountants, and then become involved in a company that started as a one person and one nurse, so one veterinary surgeon and one nurse in a small veterinary surgery practice in Townsville, and grew to an Australian-wide corporation. And Andrew became the chairman of that company and was the chair for 10 years, and the company has now been sold, but it achieved the status of being a top 200 ASX company. And he kept on saying in the interviews that I've done with him, the key thing for the leadership team right from day one is the rhythm of meetings, daily, weekly, monthly, daily, weekly, monthly, that they're looking at all aspects of the business. The weekly performance reports. I was a chief financial officer and company secretary of a listed public company, and I quickly found out that big companies want to know everything that happens each week, not at the end of the financial year, which is the treatment that our profession gives to the vast majority of SMEs. Big companies want to know for each individual business activity. What was the performance for the week? Did it meet expectations? If it didn't meet expectations, they would put someone in to find out why it didn't meet expectations and fix it up, so that a problem wasn't allowed to just fester away for the rest of the financial year, which may have been 51 weeks, that no one knew the problem was there. It was fixed. This is important for your clients as well. And each month there was the 12-month rolling cash flow forecast prepared. Cash flow management is probably the most important issue that our SME clients have got. What do we really do about it? Are we sitting down at the end of each month looking at the debtors, the creditors, the investment in work in progress, capital expenditure, bank loan or other loan repayments, commitments to paying dividends? What's all this mean? And if your clients are securing supplies from overseas, has there been shipping disruptions because of the unfortunate wars and other skirmishes happening around the world? That's delayed shipment. That's meant that your client's saying, oh, well, we'll have to hold more stock. We'll have to get more raw materials in. But is anyone really thinking of the cash flow implication of that? That's of vital importance also. So this is what these companies that are getting ready to list on the stock exchange are going through. But I don't think it's unique to them. I think this is just good, sound business management. And I hope you agree. A private company should have at least a board of advice, and a board of advice that they are paying the advisors, 2 or 3 advisors. They don't have director status or responsibility. It's a great concept. Or they could have established an independent board of directors. And what I mean by that is just not all family members, unless the family members have really got something to contribute. They're broadened, so they've had some outside input. You as the accountant may well be on that board if you want to be. Obviously, a company going to list on a stock exchange has got to have a board of directors ready to go. The company has a strong commitment to team member and leadership team training. This is very important. We need to have our team remembering that Everything's changing. Everything's changing. AI, we half heard of it a couple of years ago, but now it's coming at a very fast pace at us all. What's that going to do to the businesses that have been created? And one of the major aspects that I found in a public company was the valuation. Now, if you're on the stock exchange, the valuation's made a little bit easier for you, isn't it? Because the stock exchange is putting a market value on your shares. And it's pretty hard to argue against that, because the market should have all the information. Public companies have got an obligation to keep the market informed of anything that's going on in the company. Announcements have to go to the stock exchange. A private company hasn't got that obligation, but one way of overcoming that is to implement into the strategy with your clients an annual valuation. Sit down and prepare the valuation, or get someone else to prepare the valuation, as if you were going to sell the company, and measure that valuation improvement. Let the leadership team know what the result has been, because this is the reward for the overall input that's going on in the business. An auditor. Now, obviously, if a company is going through the initial public list offering to go to the stock exchange, they need to have appointed an auditor, because the accounts had to be audited for the previous 12 months as part of the documentation that is submitted to the stock exchange for review. So these are the key strategies that a company aspiring to be a listed public company has to go through. I think most of them can be implemented for your business clients, those who are wanting to grow and ultimately to sell their business. So when a company has undertaken the initial public offer, the marketplace generally calculates the value of the business at around 10 times the after-tax profit for the previous 12 months. 10 times. Now, some companies can be lucky and they'll get valued at a higher multiplier, 15, 20 times. Depends on the track record. But if we're dealing with everyday SME type companies that, unless they've created some huge new invention and got some fantastic new product developed, I think we'd be saying, well, the medium we're comparing to is around 10 times the after-tax profit of the business. And that's the theme that I'm using in this presentation today. So this means, obviously, and I know you could do these calculations, but I wanted them there if you were going to show this to some of your clients. If the after-tax profit was $2 million for an initial public offer, the expectation would be that the market would value this company, the shares in the company, depending on how many shares there is, of course. So the share value could be $2, $4, $20, depending on the number of shares on issue. But the overall value would be $20 million or thereabouts. And in some cases, the valuation could be higher, as I just said, because the higher profit multiplier is being used. Now, it's true that a component of that 10 figure is because the company is going to be listed on the stock exchange, and there's definitely a value, the prestige, the liquidity benefit. Now, the liquidity benefit is not so much in the cash flow of the business that I'm talking about. It's the liquidity for investors to be able to sell their shares. That's important in a public company, because you could make up your mind this morning that you wanted to sell your shares, and you could probably have a deal transacted and the money in your bank account by this afternoon or early tomorrow morning. You can't do that with a private company, of course. So I'm saying that this additional scrutiny that is required from the stock exchange, this requirement to report on any changes, any key personnel that have left or passed on, the stock exchange has to be kept informed. That's the whole idea. It's an informed marketplace. So I'm saying out of the multiplier of 10, I think at least 2 relates to those benefits of actually being on the stock exchange. So the average price multiplier, I think, that could be aspired for by a private company is around 8. Now, I've known of situations where people have gone beyond 8, but for the purposes of this conversation today, I'm suggesting to you 8. Now, remember, what we're doing here is trying to set up a structure that a client can maximize the value of their business when they sell it. Now, unless the client gives you a couple of years' notice, you're not going to be able to do that if someone walks in the door today and says, I want to sell my business and I want to have the whole thing settled within 3 months. It's a bit late to go back and set up this type. So there's no way in the world your client would get a multiplier of 8. The average price multiplier for a well-performing private company is around 4 times the after-tax profit. In some cases it's only 3, some it's 2. Depends on the business, depends on the industry they're in, but it's not at the dizzy heights of being up around 8. If the private company has undertaken a systematic program for the implementation of a strategy to think and act like a public company, this can have the potential that the valuation that's attributed to them can be 100% higher than the traditional way of valuing a private company. Now, I think most of your clients would be quite happy with that. And there's a significant side benefit that I've noticed over the years, that companies that have gone through and implemented this type of process also increase their profitability. Why? Because the profits have been analysed a lot more closely. There's the weekly performance report. If something goes wrong, it's picked up within 2 or 3 days of the end of the week. Or if it's not picked up, it's under investigation to find out what went wrong. What changes do we need to make? This is what the big end of town do all the time. I found it. I was involved in it. Going back, looking at results. The industry I was in the meat industry. So we had major meatworks producing export meat to go overseas. We had hundreds of retail butcher shops. We had other businesses as well. And each of them was subjected to a weekly performance and profitability report. And if there was a problem, there was immediate action to fix that problem. This is the sort of control that SMEs need. Because what the big companies do, whether it's Woolworths, Coles, IGA, the whole of the meat industry, people running restaurant chains, McDonald's, all analyse their performances, in some cases daily, but mostly around a weekly performance. The whole process requires input from team members throughout the organisation. This is not something that's just going to be done in a little unique group. It has to involve the whole group of people that are involved in the business to be switched on the concept that we're working on this as if we were a public company. Now, when people work in public companies, they don't really appreciate, unless they've come from a background of being in a small business and going into that larger business, they don't really realise that there's a big difference. But I did. I went from a graduate accountant who'd worked for a few years in a chartered accountancy firm, and then decided I wanted to see how the business world really operated. So I joined as an area accountant in the organisation I ultimately become the chief financial officer of. And it was a tremendous shock, because what were the results for last week? Wednesday was the vital day, because that's when the CEO was getting the results. Later on, when I was the chief financial officer, we would have a sandwich every Wednesday and we'd go through the results. And he was immediately onto the phone. We didn't have the communications we've got at present. Onto the phone to the local area manager and inquiring, had he sorted out what the problem was yet? Because the area manager would have known the results probably 24 hours earlier, because they'd been prepared by the area accountant that he had allocated to him in his area. This is how big business operates. Yet a lot of our SME clients are in the same shopping malls as big businesses. I've seen situations, of course, and we all have, that just outside a Woolworths store, there's a butcher shop, there's a bread shop, there's a delicatessen. There's all sorts of businesses. The same things are 40 or 50 metres away in the Woolworths complex. How does that little business just stuck outside Woolworths really compete? Because the Woolworths manager of that overall store, the store manager knows by Monday afternoon, and I've talked to some of them, and Coles managers and IGA stores, I've helped in some of the IGA franchises implement these systems. They know the results for all their departments, 40, 45, 50 departments in their stores. So this is putting into practice what I'm calling the public company strategy, the public company system. So to do it, you need input from all the team members. So what's got to happen? Well, staff. One of the real questions is, whenever you're looking at businesses being sold, can they operate without the owner for a month? Customers, are they loyal? Is there a thing like a customer advisory committee? Is there feedback being received? And this will all help in the documentation in putting together a sales manual. Suppliers, is there strong, dependable relationships, or are they all ad hoc? The premises, do they need an upgrade before we try to sell? Maybe a coat of paint, maybe a few other things done. Systems, is the business scalable and ready for due diligence? If a potential purchaser said, I'd like to put your accounting firm in to do a review of someone else's business, are they going to be ready for it, do you think? If they're running an SME, or they're going to be running around trying to put figures and information together. Whereas in a public company, it would basically be available. So pre-planning is very important to convince a purchaser to pay a higher price. Because the position I'm coming from is normally the purchaser on that business showing a $2 million after-tax profit would only be thinking they were going to pay a maximum of $8 million, 4 times the after-tax profit. And we're going to them and saying, well, we're looking for $16 million. And they're going to say, oh. So this pre-planning is very important. The documentation needs to be produced. The key performance indicators have been analysed. The business metrics have been analysed. In other words, there's an accounting system driving all this, as there is a business management system. And this is important for valuations. And I think this planning should commence from the first day that you become involved with the client, hopefully at the very beginning of the business, that you are outlining to them what could happen down the years, that they will be wanting to exit and maximise their contribution. Because a lot of small business operators do not contribute to superannuation anywhere near what they'd be contributing for their employees, because they're ploughing all the money back into the business. But one of the ways to really create a great superannuation exit for them is to have worked on the business to improve its overall valuation. Now, this is a real story. I was involved in this process. I was an advisor to this particular business. A few years ago, one of our clients received feedback from a potential overseas investor. The directors told me they'd been talking to an overseas investor and he was coming to Australia. And he was part of a major company that was generally in the same industry that they were in. And they were excited. They thought they were going to do a deal. And I said, well, lads, don't get too excited. I think there's going to be a process here and it might take at least another year, but I don't think you'll be ready yet. Oh, don't be like that, I got told. Well, that gentleman turned up and had his meeting and spent a day and a half with them, I understand, and said, well, your technology is excellent, your work ethics are very good, but you're not investment ready. You're not ready for our corporation to look at you and pay you a substantial amount of money, because that was their objective. So the client said, well, what do we got to do to become investment ready? What do you mean by investment ready? Because the external accountant for this firm hadn't pointed that out to him. I was there as a external consultant. They were involved in a government program that I was the consultant for. So the overseas investor said, well, we're looking for systems for every process in the business, a bit like we've been talking about today. We need to know there are internal control systems. We need to know that if someone puts the wrong name on a check or transfers money to the wrong account, that it's going to get picked up, that there's an internal control system. We want you as the directors to be appreciative. You're now in the big league. You're in the Premier League in England. You know, it's tough and it's hard, and managers get the sack after 3 or 4 games if they're not winning. So you need to understand that some things happen in big companies, and we say to you, you've got to pay $1 million a year for international research and development. We don't want you bringing up and saying, what's all this about? You know, you're part of a big corporation, so you need to understand there are head office charges, there are international research and development charges. The accounts need to be audited, and the audit reports, and we want an independent board of directors. Now, 1 or 2 of your current directors who are the leadership team can be on the board, but there's going to be another 2 or 3 people that we will appoint who'll be on the board, and they might not all live in Australia. We want an annual valuation of the company so we can gain an appreciation of how the business is performing. So the directors of the client company took that advice very seriously. They said to me, we're going to get ourselves investment ready. We want to get that high multiplier that you've talked to us about. And he had told them that to get a multiplier of up around 10, you need to have all of these things in place. So they appointed the independent board of directors. They appointed the full-time chief financial officer. And they confirmed to that chief financial officer that a prime component in this role was to ensure that the systems were discussed and implemented in every aspect of the company's operations, and a very detailed manual was to be prepared. And they appointed an external firm to conduct an annual valuation of the business as if they were helping a company do an initial public offer. And the consultancy firm that was appointed had been a regular participant in that type of process for companies aspiring to list. There was a lot of emphasis put on corporate governance. All of the executive directors undertook the Institute of Company Directors Diploma course, which I recommend for everyone. I can remember undertaking that course a long time ago now, after having been the company secretary of a listed public company, and I wondered whether I really needed to do it, to be honest, a bit conceited. I only did it because 5 of my clients told me they were going to do it, and I thought, geez, I better make sure that they don't come back asking me questions I don't know the answers to. So I undertook it. It was a great decision. I really enjoyed it because they were looking at the most frequent legal decisions in all sorts of things as it affect company directors and companies, things that in the day-to-day hassle we might not know exist. And of course, I think I've said the auditor was appointed. So that's how they live then. They run their business. And 2 years later, when I was no longer involved, but they had contacted me, after embedding robust systems, corporate governance, financial disciplines, and systems for every aspect of the business, on the basis of this daily, weekly, monthly rhythm of meetings and reports, they sold the business for a price-earnings ratio near a level for the company undertaking an initial public offer. And I've told you what that is, up around 10. They sold the business. They were very happy. And one of the other very interesting things was, even in this 2-year period that they put all this together, they improved their profitability. So whilst they were doing all the documentation, they had a full-time chief financial officer working for them. They didn't have that person before. Because they were getting a lot more information and systems and key performance indicators and business metrics, the overall profitability of the business was also increasing. And when that's getting multiplied by an earning factor at the end, that was great news. I don't think any of them expected that to happen, but profitability increased. And I put that down to because there was a tightening of the systems. There was this weekly review of what went wrong, fixing it up, sorting out the problem, changing the systems in some respects to make sure it didn't occur again. The benefit was the bottom line profitability before tax improved. So this is the power of strategy and system structure and discipline. It wasn't chance that this occurred. It was a thought through process. The two key people involved in the business really made no secret this was their aim, and they went about it very methodical way to get that to occur. So they were able to negotiate a very satisfactory exit strategy, and then part of that negotiation, they ensured that the business they had completed was passed on intact. All the management positions were retained. I last had contact with this business about 4 years ago, and it was going great and is now under new ownership, but the business is performing very well. So the business has grown. It's performing very well. So advisors who plan early and lead with strategy don't just sell businesses. I think they build value. I think this is one way you can really contribute to the valuation of a business. Because for that client that walked in this morning and said, I decided I want to sell my business, I've had enough, and try and get it all through. I want you to make some input and do some things, and I hope I've got a buyer and we've been settled within 3 months. You're not going to do anything dramatic to the price. You're just going to tidy up a few things. And you might get 3 to 4 times after-tax profit. But with this pre-planning, you can really improve the overall multiplier that's going to be used to determine the value of the business, because you'll have that history. So the real value comes when you start early. Ask what your client wants to achieve from the business. Remind the client that at the end of the day, they will want to exit the business. In most cases, some people like creating family inheritance and inheritance trails, but comments I'm making today are for someone that's really wanting ultimately to exit. And to exit, they would like to receive the maximum valuation. I think building the systems to support that goal is very important, and building those systems is very important for the ongoing profitability and performance of the business in any case. And measuring that valuation improvement each year in accordance with formulas that have been agreed to. And that might mean that you've gone through, and which I've done for a couple of clients, we've gone through and worked out a chart and said, okay, if you really perform well now, that's probably a multiplier of a 4. Now, to go to a 5, you need, out of this checklist of those items that I had there before, you need to have completed at least 2 of them. So we then say that's going to be a 5 times. And if you want to go to 6 times, you need to have ticked off more of these items on this overall list, and so on, 7 times, 8 times. So you can have a methodology put in place for the determination of the valuation of the business. And quite frankly, I think this is what's needed in Australian business, because it's what happens on the stock exchange in any case. The stock exchange is important, but it shouldn't be a great mystery of the way businesses operate there. Small businesses can do the same. Because the current way of running small businesses in Australia is not outstanding, is it? The small business ombudsman's produced some reports which are saying at least 50% of small businesses in Australia are in some difficulties. The failure rate's the highest it's ever been. I think there's a requirement for a significant change. In fact, I think this is a huge challenge for accountants and bookkeepers to really start thinking about and talking to clients. And if the client says they can't afford you to operate a virtual CFO service with them, I think you should be saying to them, well, I think you better go away and rethink your business model, because you're probably going to end up one of these horrible statistics. That might be the kindest advice you can give them. So measuring the valuation improvement every year is very important, especially if you can tick off that the stripes have been earned. You know, we've achieved 2 or 3 of these key indicators. We've done that. We've now got all the systems documented. We've done some of the other components. So you reward with the valuation, or you hire in an external expert in the valuation of companies for listing. So this is the proactive delivery of financial, commercial, management, accounting, advisory services, and will really turn your firm into the trusted business partner, the one who helps clients turn years of effort into maximum reward. At ESS BizTools, we've been working on this philosophy of approach to what needs to be done within a business to improve its chance of success, to help the business survive, first of all, but then to thrive. And then if the business wants to scale up to be a larger corporation. I think our aim should be that every business is able to thrive. It's up to them to decide whether they really want to scale up into a much larger business. Their turnover now might be $3 million. Do they really want to go to $25 million turnover? Some do, some won't. But the systems need to be implemented in any case. And the fringe benefit of all this, if it's done the way we're suggesting to you, will be an enhanced valuation on the business. Because the person buying it is buying a system that is operating to achieve success in operating their business. That I think we should all be having a close look at and understanding where the business is heading in the actual operations of the business. I was just looking for some other notes that I was going to refer to, but I think I've probably covered the matter in any case. So ESS BizTools has developed product packages to assist your clients to improve their business value when they exit the business. And in the meantime, we improve the profitability of the business. We have a Selling a Business package. It's a complete toolkit covering every step, covers the concepts that I've talked to you in this presentation. So, do you need to know more? I hope you do. You can visit our website, www.essbiztools.com.au, and click on Packages and Pricing. The Selling a Business package is available as a standalone subscription. Your investment, $330 for the year, including GST. Or you could subscribe to our advanced package or our financial forecasting package. Financial forecasting is our ultimate package, where the Selling a Business package is a component with a whole range of other products and services in those packages. I should have said at the very beginning, if you had any questions on the live broadcast, to put your questions in the chat. I can't see that there's any there, but if you're watching this webinar at a time more convenient for you and you have a question, please send me an email, peter@essbiztools.com.au. So there's a note that I had about the advanced package or the financial forecasting package. Selling a business is a very important component of the business equation for the vast majority of SMEs. But we need to make sure that people are thinking this through at the very beginning, because the statistics now being released by the Small Business Ombudsman are not a good reflection on the performance of 2 million businesses in Australia. There's some huge problems. The discipline of the systems and the daily, weekly, monthly theme is very important to help businesses perform well, and also a significant fringe benefit is that their overall valuation will be enhanced. So thank you very much for exploring this subject with me today, or at some other time that suits you when you're watching this webinar. We look forward to hearing from you so that team at ESS BizTools can assist you to help your clients thrive and scale up their business operations, if that's what they wish to do. But let's help them all thrive in their businesses. Have a great day. Goodbye. And I look forward to hearing from you if you have other questions or matters you'd like to discuss with us. Stay safe. Have a great day. Goodbye.